all. We'll be starting this off here in about a minute, just to let some other folks join in. Thanks for being here with us today. All right, hello all, thanks for joining us today. This is our second webinar, part of our Industry Insight series. Winter is coming, energy prices. Today we're going to be talking about the European perspective. My name is Tom Brady. I'm the Executive Director of the JP Morgan Center for Commodities. I would like to briefly introduce our two programs here at the Business School. The first is our Global Energy Management Program, which offers graduate, professional education, and public education across the broad commodity space. The second is the program which I have responsibility for. It's the JP Morgan Center for Commodities. We are entering our 12th year next year with the aim to provide commodity education and applied research across the broad commodity spectrum. So that's the ag space, minerals and metals, and energy. In addition to education, we have a applied commodity research mandate, which we publish a biannual journal on applied commodity research. We also have an annual symposium, and that is each August, as well as doing a lot of joint research projects with our industry partners. So with that, I'd like to introduce our moderator, Sarah Durdowski, who is the Executive Director of the Global Energy Management Program. We work closely together. Sarah is very well entrenched with the program, been with it for 10 years and has very entrenched in the energy sector here in Denver, as well as across the US. So Sarah, thanks for being here, and I'll hand it over to you.
Thanks so much, Tom. Really appreciate the opportunity to moderate this panel. Really excited. We have this fantastic group of experts here to kind of talk to us today about what's happening in the European energy markets right now. But before I get started and do some introductions of our panelists, I did just want to run through the format a little bit here so everybody understands. We certainly want to have a very conversational discussion today so that there's some back and forth. So therefore, we'll certainly have a couple minutes for questions at the end, but we'd rather they're actually incorporated into our discussion a little bit more organically. So as you think about some topics or questions you might have, please go ahead and drop them into the Q&A session, and we'll try to kind of weave them through our conversation so they can answer those questions kind of when it's pertinent rather than at the end. So definitely keep that in mind. Feel free to drop those in, even if you're thinking about them now, so we can think about how we can kind of get them woven into our discussion as we move forward. That'd be great. So Michelle will also remind you that through the chat to drop those in as we kind of have our conversation. Now, just to kind of move on to let you know who's going to be on our panel, the experts who are going to be speaking with us today. So first up, we have Fiona Boal. So she's Global Head of Commodities and Real Assets at S&P Global. So she's actually in London. So Fiona and both Sharon are going to be on the UK time zone for us today. So appreciate them making the time at the end of their workday today. But Fiona is responsible for product management, commodities, real assets, housing prices, indices, including S&P GSCI, Dow Jones Commodity Index, and CoreLogic Case-Shiller home prices indices. So she has a ton of experience currently, but prior to that, she was Director Portfolio Manager at Fulcrum Assets. She's also been with Hermes Investments, Argonaut Capital Management, and Executive Director of Food and Agribusiness Research at Rabobank International. So she has a wealth of experience across different groups to bring to us today. She has a bachelor's in ag economics from the University of Sydney and applied finance degree as well. So she is just really robust and kind of knowing what's going on kind of in the asset space. So really excited, Fiona, to have you here today. She also sits on the JP Morgan Center's Board of Advisors as well. So very pleased to have her today. Next up, we have Sharon. Sharon's Vice President of Gas, Power and Trading International at BP. And she's located, like I said, in London. So happy to have her today. Previously, Sharon's held many roles at BP over the course of her career. Some of them were Chief Executive Officer of the Eastern Hemisphere, kind of BP Trading and Shipping based in Singapore. She's just had a wealth of roles, including CFO roles at BP Trading and Shipping. Really, Sharon's career spans over 30 years in trading, progressing first starting as a trader into more senior leadership roles, and she's worked pretty much globally all over Chicago, London, Houston, Singapore. So she knows the industry up and down. So we're really pleased to have Sharon and her experience today. So really appreciate it. Sharon also has recently joined the JP Morgan Center's Board of Advisors as well. So very pleased to have her involved in that curriculum. And then next we have Bernadette Johnson. She's with Enverus. So currently she is the Senior Vice President of Power and Renewables. Previously, she was VP of Strategic Analytics. And yeah, this is one of the fastest growing business units that she is in. Bernadette is pretty much known. She earned a reputation as an industry expert, providing experience, especially on crude, nat gas, NGLs, kind of a guru on the fundamentals. She's fantastic. So her specific market involvement is finance, trading, production forecasts, infrastructure analysis, midstream, storage, value analysis, and price forecasts. You may have known Bernadette when she was at Ponderosa, Sasco. She also was at Bentech. It's kind of where she started her career here in Colorado, and also where she got her education at the Colorado School of Mines, both in her master's and her undergraduate in political economy and economics. So very pleased to have Bernadette. She's also our current executive in residence for the Global Energy Management Program here at CU Denver. So like I said, we just really have an incredible group of women, and their experience and expertise is just global and really knowing the commodity side of the business. So very pleased to have this conversation to talk about what's going on in the sector right now in Europe. So I will stop share here and let's view our panelist. So very excited. So to kind of kick off our conversation and to move forward, we'd really like to talk about how we got here in the energy market, especially in Europe. So I just direct this towards Fiona and Bernadette, if they could kind of kick us off here and kind of set the stage for us a little bit for everyone. Although this can feel like a tough time right now in the market, but there've been a lot of steps that have kind of led us to where we are right now. And so if you could just kind of walk us through what was happening, what led us up to where we are right now in the European situation when it comes to energy prices, and what was happening maybe pre-COVID, even to kind of get us here.
I can kick off and then I can hand over to Bernadette. Thanks for having me. It's great to be on the panel. Appreciate the invitation. It's almost hard to remember pre-COVID. We've been through so much in the last couple of years. But I think, where we are now, certainly is not only a function of COVID and then the post-COVID recovery. So I think if we step back and think about where we were before that, we were already, the markets were well entrenched in the concept of climate transition and energy transition. So we had seen the boom and bust cycle, say, of the US shale producers. We'd seen significant changes in the energy mix in Europe, and we'd seen, the likes of OPEC, switch and change their view of how they wanted to supply oil to the market. And I think importantly, we'd already seen that interconnectedness of the different energy sources. And that's now sort of manifested itself post-COVID But they were some of the characteristics that were already very clear to me in the market, back in, say, 2019.
Perfect. So I'll jump in. I would also say, I think all the things that Fiona listed were really key to how we got here. So then if we jump forward and we think pandemic, so what's happened since then? So it seems like a long time ago, but March 2020, we have stay-at-home orders, right? Shelter in place, stay at home. What does that mean? It means we don't use as much energy. We're not driving cars. We're not driving to the office. We're not flying, taking vacations. And commodity markets, energy markets are heavily dependent on obviously supply and demand. But that transportation element is a huge component of demand. So when that transportation stops, then demand collapses, right? So demand destruction, that's what we talk about. It happened also for power markets. So think if you're not going to your office, the office buildings aren't using as much power during the day. You're not seeing the same type of peak behavior in the evenings that you saw previously. And so everything really started changing pretty much overnight. So it's March, demand destruction, prices collapse, prices start to collapse, put pressure on OPEC plus. Saudi Arabia and Russia have a price war. The really managed supply that the world had been living with for the past 5 years or so, that falls apart. And it's kind of a free for all. Production starts ramping up, puts further pressure on pricing. And so that was March. And where have we gone since? We come out of that, we see OPEC plus other members return to the table. They reinstate certain supply reductions. They manage that very closely. We see demand start to recover slowly at first. We see things like air travel come later, but you see a lot of volatility, right? You hear news about the virus and new variants and what that means for potential new lockdowns. And the market reacts on a tweet, right? A tweet can mean a significant jump or drop in prices for commodities. And so that's really the environment that we've been in since. I think one of the other things I like to always point out is the energy markets, they actually work very well. It feels very chaotic. So you hear crude price goes negative and it's kind of shocking. But I look at it, and from an economist background, it's working just like it's supposed to. If you have way too much supply, the price comes down in response, you see production shut in. If it's more recent, where you have demand start to recover, supply is slow to come back, you see prices shoot up, especially for things like natural gas, if we're looking at Europe or other commodities focused around this winter. And so I think that's one of the things I go back to, is it feels very chaotic, but the market's actually working pretty efficiently well. I think we'll talk about the policy aspects during this conversation. So that's obviously another layer of nuance. But volatility, that's the word I probably use 10 times a day to help folks understand what's this market doing, why is it behaving like this, and what should we expect going forward.
I would just build upon that a little bit. I think you set it up well, Bernadette. I think if we just think about what's happening with respect to COVID delays of LNG facilities that were happening, with respect to workers not being able to get to facilities, as you said, things were shut down a bit. Last winter, we saw quite a bit of bad weather. Whether you were in the US, there was Hurricane Ida, Storm Uri, very important events, but also in Asia, it was a particularly cold winter, and we saw a lot of Asian buying last winter. And then coming out of the COVID overhang, one would say, we saw demand rebound very quickly globally, and the US already exports LNG at max volumes, so they're putting what they can into the global market, but for as long as weather is supportive with low wind, low hydro, some of the inventory build that we would have expected, particularly around European gas markets, to have happened in the shoulder months, really didn't have an opportunity to do that. And Russian flows, which would typically have also come into Europe to help build supply, weren't coming in. They were going to Russian storage, we believe, more than directing those flows into Europe. So there's been a lot of events and activities that have led us to a point where European natural gas prices in particular are at near record highs. So, what is the equivalent of $200+ a barrel of oil equivalent at the moment? And it's very interesting dynamics around where to from here with respect to those prices and what's going to impact the market.
And no, I think that really sets the stage, and appreciate all those perspectives there. So curious if we could dive in a little bit more into some of the structural reasons as to why pricing is that way. If we could talk a little bit about how some of the lack of supply and what's going on there, and what's being done to maybe help alleviate some of that supply. If we could talk more specifically about that. And maybe Sharon, if you want to just elaborate a little bit more on that.
Yeah, I mean, so recently in the past few months, European gas demand is actually up 5% year on year, which has been supported by those colder temperatures and as we've come back, higher space heating requirements. Because even if you decide to shut other activities, we still globally like to heat homes, and some of the demand destruction that would happen in other parts of the energy sector maybe don't happen quite as significantly in a natural gas market, depending on how you're certainly generating your power, for example. And as I said, supply is tighter due to those lower flows into Europe. And so actually those flows are down 25% year on year into Europe since October 1st. So current gas storage levels are running 18% below 5-year average, which is a very important kind of figure by which people look to see how we're running around storage. And the Northwest Europe storage levels have actually fallen 66%, particularly in areas like the Netherlands that end up balancing the UK and Belgium, for example. So, it's an interesting time because things that are going to drive price from here remain a lot of the unknowns. Weather, we're seeing some political tensions in Europe, and there's unknowns around infrastructure like Nord Stream 2, which I'm sure we will touch on a number of times in this conversation, and whether gas flows will arrive in time for some of these winter demands that have come back. The impact, as we've seen, certainly in Asia, other areas, as well as in Europe, industrials maybe have had to slow some of their production as a result of the expensive cost of the inputs, the feedstocks, in particular if they're using natural gas. And it's possible that actually if prices fall, that those come back and create another demand source. So interesting times, as well as I think Fiona and Bernadette both touched on, the shift in the energy transition and the growth in renewables and the intermittency that is now also coming into our world more, and therefore needing natural gas in a different way to help manage intermittency, which has grown particularly in Europe as renewables build out.
That's a great point, Sharon, and that kind of leads into a little bit, and Fiona, as we kind of move into this conversation a little bit, we talk about nat gas being a big player in Europe, but what other alternatives do folks have, kind of either in EU or UK there to substitute or to maybe kind of provide any sort of alternatives for them to some of these higher prices?
I think, as Sharon said, I mean, one of the issues that we have, and it's more prevalent, I would say, in the UK and Europe than it is in the US, is that as you move more of your, or you try and move more of your baseload power to renewable sources, you have that issue of the continuity of supply. So if the wind doesn't blow in Scotland, which crazily it hasn't been or hadn't been, that has a direct impact on availability, of power to the grid. And, and there are, challenges around that substitutability. And, even though someone like in the UK, that, been calling now for the complete shutdown of coal-powered electricity, in the last month or so, some of those mothballed plants have had to come back into production because you needed to guarantee the continuity of supply. So I think it's a function of these very unusual times where we had almost simultaneously a demand and a supply shock to the system with COVID. The markets then recovered relatively quickly on the demand side, and maybe traditional supply has not quite kept up. And then simultaneously, you've had a situation where the market from a regulatory perspective and from a sort of consumer demand perspective, is trying to move as quickly as it can to more renewable sources. So you almost had a perfect storm, creating what has been called the current energy crisis.
Yeah, it's actually interesting to see coal pricing into the stack so much. It's so contrary to the energy transition conversation, but at these prices, that's what we do see being run, even with carbon credits also at highs. So it's very interesting dynamics around the pricing of the various components of the energy markets at the moment.
The issue around the carbon credits is fascinating. I was just looking before the call. So I'm just going to look at my notes here, so I've got it. So we have an S&P GSCI carbon emission allowance index, and it's currently up 158% year to date. And even with carbon prices that high, as Sharon said, coal still makes its way back into the energy stack. So we're talking about pretty extreme situation in terms of that requirement to keep the grid up.
Yeah, just one more thing on coal. We had seen China having coal shortages when they had a bit of a disconnect, I'll call it, with Australia, and so that they were having to run probably more gas into their footprint than they had expected to too, which drove a lot of the demand in addition to winter weather last year. So very odd dynamics that have created, as you said, I think very well, this perfect storm of energy crisis at the moment.
Yeah, and you all being in the UK and just coming off of kind of COP26, right? And all this discussion of climate policy and all these agreements that countries are putting into place. How is that playing into kind of what the behaviors are actually of the UK and EU of how they're actually getting their energy right now? Are they in contradiction as to what kind of agreements are coming off of COP26, or is this just kind of a short-term blip for them, and they'll be able to kind of get back on track?
Okay, I can have a go at that one. I mean, I think it puts administrations and regulators in a really difficult position, because we won't know whether this is a one-off energy crisis, and look, we've had energy crises for as long as we've had markets, but is what we're seeing now unique because we have that overhang of that desire to transition to zero carbon, or at least low carbon sources, or is it actually going to be that we will start to see more and more of these type of events? And if we see more and more of these type of events, it really puts governments in a tricky position around, will they still be able to meet the promises that they made at COP26, or unfortunately for them, will they have to backtrack, and will hydrocarbons continue to be a major player in the power markets for longer than we would have hoped? And it's really, I think it's probably too early to say which one of those is likely to happen.
And I would add on, I would say, if you look at Europe, you look around the world, a lot of the goals the governments have or the countries are setting, I think we look at them as aspirational. And so generally the market, individual people, the public want cleaner energy, cleaner environments, these things to be true. But there's a significant disconnect between what the science can do today in terms of energy production from renewables and clean sources versus what we want it to be able to do. And so what you see policies happening that are very kind of aspirational. Dates need to get pushed. There's no clear plan for how we might get to some of these goals. And it varies country by country and what energy sources they're willing to entertain. For instance, nuclear, right? Are they willing to expand nuclear? Most places around the world, the answer is no, but it's maybe arguably the cleanest energy source and some of the most predictable and kind of dispatchable. So you layer that on, those policies and those decisions are having a very real impact on investment, investor sentiment, what folks are willing to invest in. And so that is certainly playing a role in today's energy market and how quickly supply is responding to price signals. So if we looked a few years ago, we saw in the US prices $80, $83 recently. They've collapsed more since then, but they were sitting in the 80s. That price a couple of years ago, everyone would have been excited about. You would have seen rigs rebound. You would have seen capital available to drill wells. Well, if you look at this time, we're still sitting about 660 rigs, 300 rigs lower than we were pre-pandemic, pre-COVID collapse. And so you're seeing prices higher, but you're not seeing supply respond necessarily. And so it's a very tough market to invest in oil and gas, but the world is heavily dependent on oil and gas. And so you have this disconnect where you're not seeing the investment. It's not clear where exactly this new activity or supply will come from. And there's a gap between what the renewables can do today versus what we want them to do. So all of this just adds to more and more volatility, and it makes it hard to manage these markets. And it's part of why prices shoot up, they shoot down. It's very volatile.
Yeah, I think, the coal, the aspiration for the phase down, I would call it, I can't remember the exact terminology, but the phasing out of coal over a period of time feels like it will only continue to support the need for natural gas playing a very big role in the energy transition. And so agree around the conversation with respect to volatility, both from a longer term perspective as the energy transition does play out and some of these things manifest over a period of years, but also, even today, just looking at headlines, you're seeing, tension in Eastern Europe, rhetoric between Russia and the Ukraine. You've seen weather, obviously we're in the winter, unknowns. These are unknowns that are driving and supporting what is effectively, a market that has not the traditional amount of gas storage in play for the time of year it needs it. And of course, the unknown around commissioning of this Nord Stream 2 pipeline and whether US sanctions come into play if Russia acts in ways around the Ukraine that is not seen to be what we'd like to have happen. Is there supposedly some kind of potential arrangement, we'll call it, between the US and Germany with respect to what would happen if that heated up, and therefore does that halt what is an anticipated flow of gas? Timing to be determined around Nord Stream 2. I think that's an open topic depending on who you speak to as to when it actually starts to flow, although it has been line fill is there, so it is ready to be operational. It's more about regulatory hurdles at this point, but all of these are unknowns that will keep the market volatile. And whether we see that volatility and the elevated levels continue is very much wrapped up in some of this both short-term market conditions, as well as, I think, as we pointed out, what happens for the long term in the energy transition.
Yeah, and I think you guys all make excellent points when it comes to what's going to be needed in the short term, right? Is it going to be that nat gas coming in from Nord Stream 2? Is that going to kind of help bring down prices? But then just kind of a question that we had come in, which you guys have touched on. There's a lot of unknowns and uncertainties here, right? So it's hard for investment, but at the same time, do you think the question is, do you think this is going to reverse any trends of the EU to want to invest more heavily in renewables, or do you think this is just kind of a blip and they're going to kind of stay on the same trajectory that they have been on to kind of bring more renewables online?
I think that the stats today are that somewhere around the 20-25% of European power comes from renewable sources. I think it's unlikely that they back away from that commitment and to increase those that percentage in the mix. But I think what we're seeing certainly will give regulators and the governments pause to do a better job of understanding the interconnectedness of the different supply sources in the market, to understand where European energy sits in a global context. I don't think many European governments really fully appreciated the the importance of something like US LNG into the market, and also the competition for LNG, and how strong it's been in Asia, and how that directly relates to to the situation we're seeing in Europe. So I feel like it's unlikely that they will shift gears. I think they're committed to the energy transition. The increasing regulation around carbon pricing, carbon trading gives you an indication of that commitment. But I do think they'll be forced to sort of sit back and really better understand where the pain points are for consumers, largely, for the voting public, as they say.
Yeah, no, I think you're right on there, because the consumers are going to, at the end of the day, kind of drive where the policy and the regulation go. But just kind of on this Nord Stream 2, why we still have that kind of queued up here, and thinking about nat gas and how that plays a huge role in Europe and the prices. So the question was more concerned about reliability of the price and of that nat gas supply coming through Nord Stream 2 if that does get turned on, comparing that with the possibility of having US LNG imports. And I know, Sharon, we touched a little bit on that. Maybe you and Bernadette could elaborate on, what is that potential for US LNG being more reliable than maybe what's coming through or available versus what would potentially be coming through that pipeline?
I mean, I can start and then Bernadette maybe pick it up, but markets are efficient, right? So if the gas doesn't flow, I guess, through Nord Stream 2, you're going to end up with this competition of LNG cargoes between Asia and Europe, and that's going to sort of figure out where things go. So hard to know about the reliability, but I think whatever ends up happening, will sort of manifest itself into what would be, how good markets will work, and therefore, what we're seeing today, some of that competition of cargoes between, Asia and Europe, may continue. Now, you could also say at these more elevated prices, it also incents investment into some of these areas, like newer LNG facilities in the US that we would see making it to FID. So while not a short-term solution, that would incent potentially more production and therefore more overall LNG into the markets. But conversely, even just today, Norway production from Troll is going down, and we don't know for how long, right? So you have these day-to-day supply demand imbalances, and then the longer trajectory, but really hard to comment as to whether Nord Stream 2 flow would be reliable enough. I would just say the markets will then sort of act as they need to. But Bernadette, I don't know if you would add anything or have a different view to that.
Sure. No, I think I agree with all that. I would probably add that no single source is completely reliable, right? So exactly what Sharon said, the market will balance, and there will always be these kind of black swan events where we know something will happen, but we're not quite sure what. Maybe it's maintenance, maybe it's political upheaval, maybe it's like in the US right now, the rig count is relatively low, and a lot of the production in the US, you actually produce oil and gas. And so they're directly tied together. And what we know from pandemic recovery is gas markets rebounded sooner and stronger than oil markets, and oil markets are still lagging behind. And so knowing that, well, there's a lot of production from the Permian region, for instance, in the US, where you get a lot of associated gas, but we're not drilling as much for oil, so we're not getting as much of that natural gas. And the US gas market is also, demand is relatively strong. And so now you have the situation where supply is lower than it was for gas pre-pandemic. How soon will it come back? What price do US operators need to see to be willing to add rigs and drill more wells? A lot of that is unknown. And this, again, goes back to that investor sentiment and how we're seeing money flow through to these various energy sources. And so the US, even today, I would say, recently exceeded 12 BCF a day of deliveries of gas to LNG terminals, new records, right, for several days in November. But that supply is not necessarily completely dedicated to LNG exports. If US weather is cold, we'll keep that gas here. Prices will basically signal that. And so it's, when you think of global markets, they're all connected. No single source is completely riskless. And I think we should expect that there's going to be these kind of ebbs and flows, no matter where the gas comes from going forward.
Yeah, it's a great point. I think there's just a lot of companies here in the US who have some gas assets, and they see prices and are just very excited about gas actually being the marketable product as opposed to oil, and see a lot of potential to want to ramp up if they could. So I think that's part of the discussion. It not just being the oil people want, it's the gas now is actually the marketable product.
Yes, and it's interesting. Earlier this week, we lost 50 cents in the US gas price. In kind of 1 or 2 days, it's rebounded up a bit again. But today, I think it's prompt month, we're sitting at $3.86. So it was above $5 for periods of time. And so we've already seen it very volatile, but coming back down to the mid $3 range. And the market here at least is comfortable with the idea that we're not going to run out of gas for the winter. And our winter, I mean, I live in Colorado, and it's usually snowed quite a bit by now, and it hasn't snowed but barely a dusting. And so that relatively warm weather means we haven't used as much gas. The market's okay now. Prices have collapsed. But if you're a US gas producer, it's got to be kind of heartbreaking. Prices were very high, and now we're in December and they're back in the threes.
Well, let's talk a little bit more about regulation. That obviously affects prices, it affects consumers. So curious, from the EU perspective, how are some of the individual countries affected differently based on their regulations when it comes to some of these pricings? And then how is that kind of trickling down to consumers? I know, Sharon and Fiona, in the UK, it's a little bit different on kind of the electricity markets. Wondering if you guys could kind of elaborate a little bit on that, of how regulation issues are affecting some of the pricing.
Sure. I think, as we've seen natural gas prices rally significantly over the past few months, what's come to light is the UK government in 2016 decided that they wanted to move away from 6 big utilities serving power to the residential and C&I markets, and to make it much more competitive, and hopefully for consumers to get better pricing on their utilities, gas and power. And that market went from 6 utilities to about 70 in September-ish. And what happened was, the bar to entry was lowered quite significantly, and a price cap was put into this dynamic. So you could, as a REP, only sell your gas for a certain amount of money. So what happened was, as the wholesale market rallied, the price at which you had to pay for the gas that you were going to provide to a home or a business was more than you could sell it for. That doesn't sound like a winning business model. And so some of these smaller REPs, less capitalized, working capital issues, and potentially those who chose or didn't know to hedge the commodity risk, were then in really tight financial strain and have gone under. So since September-ish, we've seen 30, give or take, fail and need to be consolidated back into other bigger reps who could absorb the customers. So the conversation has obviously been loud around the benefit or not of a price cap. Does that need to change? How does that work going forward? Because I don't think the UK government anticipated the market conditions which drove massive failures of retail energy providers. So it's been, not just the underlying commodities, but the impact of that has been very eye-opening, particularly in the UK utility market. But I would say, Fiona, anything to add to that?
I think the UK situation is a fascinating one, and as Sharon said, for a lot of these smaller retail providers, it would be interesting to understand, and we will probably get to a point where that comes out, whether this was a lack of working capital was the reason that they chose not to hedge. Was it a lack of education or ability or access to those markets, or was it actually a choice? Were they playing? Did they have a strong opinion on the pricing in the market? But it certainly, very much disrupted the UK market, and I would expect, that there may be changes to the process. I think, in other European countries, the approach has been slightly different. Countries like Spain and France, have in recent weeks and months, been forced to or chosen to offer direct financial assistance to the consumer. Whether that's been, as cash payments or as sort of other ways to defray the cost of the domestic utility bill. And then again, in other markets, including here in the UK, there have been very strong conversations with some of the larger industrial players around, their use of electricity at certain points. And that's, bled through into disrupting other markets, whether that be the production of fertilizer here in the UK, the production of carbon dioxide, which importantly in the UK is used in beer. So that got a good run in the press. But it sort of shows you that even within Europe, that the government responses have actually been, very different. And at some, in some markets, it's been about directly engaging with the utility, and in other markets, it's been about providing direct support to the consumer.
Mm-hmm. It'll be interesting to see how everyone works it out, right? What their regulation comes in, and then kind of how the market balances a little bit. I mean, because consumers being affected on multiple levels, not just with energy prices, right? They're being affected by inflation of kind of across the board of some of these externalities with these higher energy prices that are causing for them. So curious, could anyone kind of speak to what are some of those other externalities maybe that the consumer is having because of these higher energy prices? How else is it kind of affecting them at the end as an end point?
I can have a first go at that. I think in the area of inflation is really where we've seen that bleed through, and largely bleed through, get my words out, into food inflation. And unfortunately, food inflation acts essentially as a regressive tax, as arguably does higher petrol prices. But those that can't afford it are the ones that are impacted the most. And if we look again, and we're seeing similar things happen in the US, but if we think about the UK, food inflation running well over 2% a year, which might not sound like very much, but it compares to under 1% a year over the last decade. And so as we see higher energy prices combined with higher wages, combined with ongoing supply chain disruptions, all of that increases the cost of producing stuff. And whether that stuff be food or consumer goods, then what we're seeing with that is that prices are going higher, and it's hitting those consumers that can least afford it.
Mm-hmm. Yeah, the affordability is just that's always the question too, as we think about also what type of fuel source and things we'll use. Bernadette, I made a note when Fiona and Sharon kind of were talking about, why were some of these retail markets, did they actively choose not to hedge? Was that, part of their strategic plan? Was it not? And I just wrote down, thinking about the US power markets and kind of what's going on. I mean, we've had quite a few good examples of, ERCOT's a great example of, them choosing actively a different business model, right? To actively not, whether it's do maintenance or what have you, but to make these choices. And, just wonder if you could elaborate a little bit there to say, maybe how that, our little case study here is similar of choosing not to do something and what that means.
Yeah, no, absolutely. So in the US, the power markets are really interesting. Every kind of RTO or ISO, so territory that's managed, they each have their own market design. Some have kind of open market style like ERCOT, where it's just the energy price, just the electricity price. And that market mechanism is expected to solve resource availability, the price of power, and that was an intentional choice. And so that's Texas. Then you look at California, very different market design. You look up in the Northeast or the mid-continent, and you have other types of markets, like capacity markets, where you're basically paid to have resources available in case we need them. And there's pros and cons to all of this, but they look very different. And I think to your point, do you hedge, do you not hedge? We do a fair amount of analysis on gas supply plans and power pricing and how that's passed on to utilities here. And it's interesting because it's almost impossible to look back in time and predict, well, what should they have done? right? So these prices that we're hedging, they're changing constantly. There's a price to hedge, like there's a cost to hedge, even to have those contracts on. You have a team that's basically making educated decisions about what they think is going to happen, but we're basically gambling on weather, right? Does weather show up? Is it cold? Is it warm? And so these are just inherently difficult things to do. And so you see everybody has a little bit different flavor, a little bit different risk appetite. And sometimes you see it kind of blow up. And you see energy prices in Texas at $9,000 and utility bills going out to customers that are very high. And now we have to create new kind of bond systems to pay for it. So it's a different challenge no matter where you look. But these energy markets are complex. And I think they are all connected. And when you look from the outside, it looks like it should be pretty simple. But every one of these things is actually fairly complicated.
Yeah.
And just building upon that, if I just talk about the UK one more time, these were small, in some cases, shops that had, tens of thousands of customers, not millions. And so, as Bernadette points out, there's a cost to hedging, whether you need to post, cash collateral to keep on futures that you're using as hedging, for example, or you need to have open credit to do over-the-counter types of products. If you're a small entity, is that as easy? If you don't have, the kind of balance sheet that would warrant some companies wanting to take the credit risk. So, whether it was a choice or a view or just the realities of some of the nuances of hedging, I think it's, a great case study that we will end up having to reflect on, certainly in the UK anyway. But I think Bernadette points out it does take, effort, conscious construct to hedge as well.
Mm-hmm. Yeah, and I think it just being so complex in Europe and the UK, so many different countries involved, so many different regulations and regulators involved. It will be interesting to see, kind of what the role is for regulation at the kind of state level, and then the larger kind of a collaboration level of what it means for energy prices and how people are going to respond based on their localized policies. We certainly have that here in the US with state by state, and then our regions as to how that affects policy. So we talked about how complicated the markets are, even though they are fairly functional energy markets, which is great news. Bernadette, to your point, they do what they say. Prices respond to supply and demand, and that's kind of what's happened out there. So curious, as we move into winter, certainly in the U.S., in the Western U.S., we've had kind of a lighter winter. It's been, to Bernadette's point, brought down prices here on natural gas for sure. But what does that mean kind of going into winter for Europe? So I wonder, Sharon, Fiona, if you guys could just, are you optimistic for prices kind of moving into this winter space, as this is short term and we have some alternatives and we're kind of moving forward, or just kind of what's the feeling there as we kind of move into kind of the next season?
I mean, the only thing I would say is volatility. I think it's been said a couple of times by others. You've got COVID unknowns, variants. What does that mean? I mean, even here, whether or not there's more restrictions, I don't know that I'd say lockdowns, it could be, but we don't know what's going to happen with COVID. We don't know what's going to happen with weather. And we also have other unknowns, as I said, sort of political rumblings. So in the short term, I think the best thing is you can expect volatility. And then, like any other usual season, I guess the farther we get into the winter, you get more confidence as to whether or not, it's going to be a supply crunch or not. I think, some of what you're seeing probably in the last day or so in the US is that weather hasn't shown up. So it's relieved some of those prices. And I think it's still a little bit to be determined. I think we've had colder weather in Europe to date. So it's keeping prices a bit firmer here, is what I believe to be the case. But Fiona, happy to hear your additional perspectives.
I mean, I think it's almost impossible. I mean, it's always almost impossible to predict prices, but the confluence of factors today is just so extreme that anything is possible. I really liked Bernadette's points earlier in the call, though, that the markets are functioning, and I think we can be relatively certain that continues, that they will do their job. Now, unfortunately, doing their job might mean that we have significantly higher prices and industrial demand gets hit, or we might see prices fall out of bed because cold weather doesn't arrive. But I think we can be confident, as Sharon said, on volatility, but I think we can also be confident that the markets will continue to work. But in which direction they go, I think this is a really unique situation.
Yeah, well, and I will say for having some economists on here, it's not as gloom and doom though, as it normally is. When I talk to some economists, there's definitely some optimism there. Well, I wonder, kind of what would you tell folks who are watching this? What would you tell them to watch as maybe some market indicators that things are either getting better or that maybe higher prices are going to kind of hang around for a little bit longer? What would be some of those pieces you might tell them to just kind of pay attention to? Maybe that's inflation, not sure, to maybe just, pay attention to as for energy prices.
I can start. I would say it's going to be a little different answer for oil versus gas versus the natural gas liquids like propane or even power markets. But I would say if we start with gas, it's always going to be fundamentally about weather in the near term. Does weather show up or does it not? And you can get a really good view of why prices are doing what they're doing if you look at those storage numbers. So storage in Europe, storage in the US, those numbers in particular are updated weekly. The market reacts to them, and it's a really good snapshot of, are we short supply, long supply, and what's happening. I would say the other thing about gas markets is they basically reset every year. And so again, prices will do whatever they need to do starting basically in the spring until the next winter. So we have enough gas for the winter season, but it also means you can only put so much in storage. And so those reset points really, for me, it says prices won't always be high. Prices won't always be low either. We're going to see this movement, but the market resets naturally. And so you can understand what it's basically going to do by looking at storage. Oil markets, I think a lot of it's demand. A lot of it is on demand. It means, what are these transportation fuels? What do they do? I think the main thing that I'm a little more bullish on oil prices. I think they're probably going to be higher a year from now. And I think a lot of it is the world is still heavily dependent on oil, but the policy and the perception is that we're not. And so there's this disconnect. And oil markets, it's huge. It's 100 million barrels a day market. And we're not investing in big conventional projects where you get more supply. And the existing production we have naturally declines. So the world's dependent, the supply's kind of ticking down outside of the short-term OPEC stuff. And that to me means we probably get to 2025 and maybe we're caught kind of short. And I think that's probably more likely than not. So I think at the end of the day, these markets are all very directly connected. Weather, geopolitics, it's fun to watch energy markets because of that, but no one answer, I guess.
Mm-hmm. Definitely geopolitics here. I feel like in the short run, also, again, just Biden's discussion with Russia, what's happening there, sanctions, potential sanctions anyways, with Nord Stream 2 in Germany and stuff as well. So I definitely think there's a lot up in the air there. And then the same thing, weather across the world, really. So Asia, US, and Europe, kind of what that means for supply. Well, it sounds like everyone is fairly in agreement that volatility is what this market is, and what it's going to continue to be, and uncertain as we kind of move forward, which is just to be expected. It's an energy market. It's always going to be volatile, which makes it a little bit exciting, but it also makes it challenging for consumers. So I guess just any final thoughts from anyone as a consumer of energy, maybe in Europe right now, as to kind of what to expect kind of moving forward. Just expect some higher prices and settle in, or to maybe be a little more optimistic that prices might be able to come down through regulation or whatever mechanism that might be there.
I'm not sure as a consumer of energy what I should be expecting, to be honest. I think one thing to think through, though, is that we are likely to see more, I wouldn't necessarily say direct government involvement, but more government interest in the markets. which can sometimes confuse very efficient commodity markets when there is government involvement or interest. I think we can also expect to keep seeing energy prices on the front page of the paper. It's a good story. It's a good story to tell. It's not necessarily a good story for the consumer. We saw that earlier in the year in the UK, where you had a run to the petrol station because the media portrayed that the UK was going to run out of petrol. So I think you can expect to continue to see energy inflation, supply chain disruptions at the front of the mind of the consumer, and often that's driven by what they read in the paper.
Mm-hmm. Yeah, absolutely. Sorry, we did have one question come in here. Curious, back to kind of like the geopolitical aspects here. Do we know if Russia really withheld any supply to the EU earlier in the summer, or to maybe kind of fill their own storage, or if the supply just wasn't there, or we'll never know?
I don't think we'll ever know definitively, to be honest. What sort of motivations, what the actions were, how it was playing out. I don't think we'll ever really know.
Mm-hmm.
And, depending on who you ask, probably have their own view as to whether it was posturing, intentional, not intentional. Who's to say? Again, it's it's not opaque. It is opaque. Sorry,
Mm-hmm.
not clear. Yeah.
Mm-hmm. Well, great. Well, I appreciate the questions. I appreciate everyone's time today. I think, again, just the key takeaways is, energy markets are volatile, right? And they're uncertain right now. COVID is certainly didn't make them uncertain, but just adds some more uncertainty to that. And then, I think Europe's always in this unique position of kind of being at the end of a pipeline as well, which is challenging. And then also has some really big initiatives to kind of meet some of these like climate goals as well. And so it just makes everything layered and more complicated, kind of moving into this new era of energy transition and what that means, right? So it's just a layered effect that is just kind of blown up for a variety of reasons. So really appreciate all of your time, you walking us through exactly kind of what's happening, what are our drivers here in Europe, and what's going on, and kind of how it's affecting the rest of the world. So this has been really fun conversation. Really appreciate all of your time and expertise here, and just really happy to have you on the call. So again, thanks so much for your time. Thanks everyone for jumping on the call today. And please stay tuned for some more industry insights as we put out some more webinars. And energy prices will always be top of the list of kind of what we talk about because there's always something to talk about. So anyways, appreciate your time, everyone, and have a great rest of the day.
Thank you.
Thank you.
Thank you.